In dealing with debt, consumers and corporate America are already feeling the effects of the Fed's quarter-point rate hike. The Fed's aim is to bring down inflation by raising the cost of loans. We have Greg McBride, the Senior Vice President and Chief Financial Analyst at Bankrate.com with us to break it all down and tell you what to expect if you have credit card debt or plan to buy a home. Always wonderful to have you on our show, Greg. And here we go. The Fed is planning 7 rate hikes this year. How soon will consumers really feel what's happening with the Fed? And in some instances, it already is happening.
Well, mortgage rates are already up a full percentage point since the beginning of the year in anticipation of rate hikes and because of the elevated inflation. And then other borrowing costs are going to move up pretty quickly. Credit card rates, home equity lines of credit, other variable rate debts, you'll see those start to march higher pretty quickly. Some of those higher rates on the credit card, for example, you might see that as soon as the next statement or the statement after that.
How can consumers get competitive rates on credit cards?
In this environment where interest rates are poised to rise, there are a lot of low rate balance transfer offers out there. Grab one of those 0% or other low rate balance transfer offers. Some of those are good as long as 21 months. And that not only insulates you from the rate hikes we expect to see over the next couple of years, but it then gives you a clear runway where you can get that debt paid off once and for all without the headwind of interest. Another strategy that people have been able to successfully employ in the past, particularly if you're getting those credit card offers in the mail or by email, is call up your current card issuer, tell them that you're thinking about taking your business elsewhere, see if they'll give you a better rate. The bottom line is it's a very competitive marketplace. If your credit has improved since you took out the card, you're in a very strong position to reduce the rate that you're paying.
How do you think all of these Fed moves will play out in the housing sector, which has been very hot?
The big jump in mortgage rates, it does add another layer of affordability on top of limited inventory and the sky-high home prices. It is going to price some would-be buyers out of the market, but not enough to really eradicate the supply and demand imbalance that we have. The inventory of homes available for sale is still really, really small. So even a reduced level of demand, that may just temper the pace of home price appreciation, but it's still very much going to be a seller's market.
We always appreciate having you on our show. Thank you very much, Greg.
Thank you, Angie.
Go to businessfirstam.com for where to see our show on TV.